The US and global debt system is a house of cards. Countries are lowering their interest rates and pushing debt levels higher to stay competitive. This is useful for near-term expansion and countering the recent economic shutdown, but it's not sustainable. Some countries are even jumping into negative yield territory to keep the party going. Towards the end of last year, close to $17 trillion in global debt had a negative yield. That number has bounced around a bit, but as governments manipulate their economies further, that total might climb higher. So far, the US hasn't breached negative yield territory. And if it does, I doubt that would be sustainable, with the US dollar being the world's reserve currency. Still, there are some major problems, and I'm about to show you a chart that reveals the real problem with US debt. But first, I think it might be useful to look at how a warfare concept compares to the global debt situation. And also, just before that, I'd really appreciate it if you tap the like button down below, as well as subscribe to my channel. Alright, countries with nuclear weapons can obliterate other nations. So if one country launches a missile first, that could easily lead to a chain reaction. And this could lead to what's called mutually assured destruction, or the acronym being MAD. So how does this compare to the global debt problem? Well, if one country is borrowing from its future self to spur short-term growth and is also manipulating its currency in other ways, other countries need to take similar action to stay competitive. Because ultimately, economic policy is more important than nukes. And if one leading country falters, it would be a domino effect in our globalized world. Bad economic policy is often what leads to war. For example, World War II was a result of a worldwide depression that really hit Germany as one of the hardest. Policymakers have learned from these past mistakes, although countries have become more connected and debt levels relative to economic growth are now my major concern. As you can see in the first chart I have for you, total US debt to GDP has climbed since the 1980s, and it's now above 100%. As 2020 data rolls in, debt to GDP will likely spike higher. The Fed has pushed down interest rates once again to counter short-term pressures. This creates more debt sloshing around our economy. So this next chart I have for you shows the Fed funds rate. It's the overnight lending rate between banks. And the Fed doesn't control it directly, but it controls it through open market operations. For most of the last decade, it's hovered just above 0%. The Fed is now stuck and has already started using new tools that manipulate free markets even further. It's recently bought $1.3 billion in corporate bond ETFs. Now, that's small compared to its total holdings, but it's a dangerous move that sets a bad precedent. If you want more insight as to why, feel free to drop a comment down below. Overall, US debt is climbing. It's climbing faster than economic output, and governments are stepping in to keep the party going. They have to do this to stay competitive and keep the global house of cards propped up. Their actions keep helping in the short term, but long term, it might not be worth it. When pulling back the curtain, there's a bigger underlying economic problem. That's why I'm linking to this video. Trends in unemployment are a key problem. And I've clearly shared some of that research recently, so check it out. And please let me know if you have any comments or questions. Also, once again, if you haven't already, I'd really appreciate it if you just tap the like button down below, as well as subscribe to my channel. Thank you.